what is the debt spiral? Well, if you look at the United States, if it was a company on the New York Stock Exchange, we would consider it to be a zombie company. So the issue here is that we run in perpetual deficit. $2 trillion of deficit spending right now, and we're not even in a recession. This is like somebody who makes $100,000 a year, who is carrying $5 million of debt, and is adding another $150,000 of debt every 3 months. You will never be paid back. So you're in what's called a debt spiral. You're borrowing more. The borrowing is compounding on top of borrowing. The interest rate is getting to be too much. And at some point, it's going to overtake all of our earnings. $1 trillion that we spend on interest every single year is about 20% of that, just under $5 trillion that we make every year in revenue. That's going to, at some point, be 30%, 40%, 50%. And if we have a shock in the system, like we had in either the Great Financial Crisis or in 2020 and the global shutdown from COVID, if we have another shock to the system like that, we could see those interest payments double or more.
We've had a 53-year debt party, and now it's 5 a.m. and the kegs are running dry and the cops are outside throughout the world. Debt to GDP is so high across the G7 and so many countries. There's no Fed to bail out the Fed the way the Fed bailed out Wall Street in 2008. If there's another crisis, it's going to be at the sovereign level, and it's throughout the system then.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej Jordanov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with sound money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Well, welcome to the podcast. I have here two special gents from the Bitcoin Opportunity Fund. I have James Lavish, and David
David Foley.
Foley, sorry.
Yeah.
It's okay.
I'm mistaken you for the photographer, actually.
Yeah.
David is new to the scene, but he's going to be on a lot of these podcasts soon.
Yeah.
Smart guy.
And lots of knowledge that we're going to unpack. Your specialty is in macro, but perhaps actually it's a good moment to maybe introduce yourself a bit.
Yeah, sure. So David Foley, I'm partners with James of the Bitcoin Opportunity Fund, and my background is, grew up in Massachusetts outside of Boston, and kind of career-wise was in New York as an investment banker in the beginning, early stages for about 7 years or 8 years of my career. Then worked my way into hedge funds for the last 20 years. Been an investor in value equity and distressed debt. Generalist, kind of all over the place, various industries, from the financials in 2008 to the oil and gas space to distressed retailers like JCPenney and Macy's. And then was always a sound money kind of follower of gold and silver and miners, and so finally made the transition to Bitcoin about 5 years ago, and was a little late to it. I was classic.
You're never late.
2013 through 17, kind of like, nah, I don't get it. I still think gold, but I've seen it. And I think Michael Saylor's presentation I thought yesterday was outstanding, and people can find that on YouTube here from the Bitcoin Atlantis conference. And Bitcoin is digital money, and I'm sure we'll get into that today. But that's my background as an investor, and James and I are excited about the Bitcoin Opportunity Fund, and we're a public and private investment firm where we invest in everything from Bitcoin and public companies on the public side of our hedge fund, and then on the venture side of our firm we do private investments as well in all sorts of exciting companies growing up in this space.
So actually, like through gold and silver, you've been able to already like see what the sound money is all about, and also like identify it through like the highly indebted system, like all the pitfalls, all what's been wrong. But what made you go into the step of what triggered you to actually go full on to Bitcoin?
Well, I think once to your point, you're right. I think most people that understand sound money, that gold, has been a store of value for 5,000 years because its supply is scarce, right? And on average, generally speaking, gold supply grows at 1% to 2%, 1.5% to 2.5% per year on average. You compare that to the U.S. money supply that, if we look at since 1971, when the U.S. went off the gold standard, the U.S. money supply has grown at 7.2% a year on average. So to me, that's the inflation rate. That's not whether CPI is at 2 or 3%. It's about monetary growth. So that's why gold has been a store of value, given that its supply grows at 1.5% to 2% area. The U.S. money supply, as an example, growing at 7.2%. In Bitcoin's case, it's the only form of, it's digital money, right? Some people call it digital gold, call it digital money. And its supply, as we know, is capped at 21 million, and its supply growth right now is growing at roughly 1.5%, right where gold is. But on April 18th, at the next halvening, it gets cut in half to now kind of less than 1% a year growth, and ultimately capped. It's the only money in the world that doesn't respond to higher price. There's, unlike gold, where gold prices go out to 5,000 an ounce, I will assure you there will be more gold production in the world. There is none of that in Bitcoin. And I think that's why it will be the soundest form of money, the hardest form of money. And Gresham's law, when it kicks in, people leave fiat and they run to the soundest forms of money. And that's why we think Bitcoin will be the biggest winner in the world.
Clear. One of the questions I like to always ask at the beginning of the podcast is, what is your most heretical view about financial markets? And this might be an easy one for you, James.
Well, first of all, thank you for having us. I appreciate it. Welcome, David, to this fray. So, that's a really broad question. It's a large question, but look, the way we're approaching the markets now is we know that its structure is flawed, inherently flawed. And we understand that it cannot sustain itself the way it has been since 1971. And that just the sheer amount of borrowing that's been going on across the world. The United States is not the leader of borrowing, but having the global reserve currency, the global reserve asset, everybody looks to the U.S. as the kind of the anchor of the financial world. And we understand in a big picture, just looking at a very large picture, that the path that we're on cannot be sustained. So as David said, with the Bitcoin Opportunity Fund and what we're doing there, we believe that Bitcoin is the ultimate store of value. It is the pristine, the most perfect store of value that's ever been created. And even better than gold, even though gold has been a great store of value for thousands of years. But because of that 7.2% expansion of the money supply over the last, half a century, we know that this is going to continue and that number is going to get worse. Mm-hmm. The money supply is going to continue to expand. So I don't really care where the market goes. It's going to be violent. It's going to have violent moves. But what we care about is storing our value in the Bitcoin ecosystem, holding Bitcoin and helping these Bitcoin companies survive and thrive as we have this violent shift and a flood of liquidity come into the markets. It's kind of the way I see it.
Mm-hmm. And you've been also best known, I think, for your debt spiral thesis. And I think you've just shared it pretty much like all across the internet. And you've been also I think a lot of people also refer to that because you've popularized it more, talked about it more. But perhaps in a nutshell, because I think it's important for what's going to come next afterwards to put a foundation, but I'm going to ask you again one more time.
Really quickly.
To just give it a nutshell.
So I'm going to ruin everybody's day for a minute, but like I did yesterday morning on stage. But look, First of all, I'm an internal optimist. So when I talk about these things, what I'm trying to do is bring light to the situation and to make people understand it and knowledgeable about it. And that's why we're so confident about Bitcoin in particular. And so, but basically, what is the debt spiral? Well, if you look at the United States, and you were, if it was a company on the New York Stock Exchange, we would consider it to be a zombie company. Why? What does that mean? Well, that means that the company doesn't earn enough in revenue and earnings to cover its interest payments on its debt. So it's borrowed so much that it now owes so much that it has interest payments that are higher than it can cover on all of its mandatory expenses. So if you break it all down, some numbers for you really quickly. The United States is going to make about $4.9 trillion this year. We expect, if we go into a recession, it will be less. But that's what the expected amount is. Our entitlement programs, and these are programs that are signed into legislation. They're in law. They have to pay these. Social Security, Medicare, Medicaid, that's about $3.8 trillion of spending. You add in defense spending, that's another $800 to $900 billion for defense spending. Then you subtract those. So just do some simple math, right? So 3.8, and then you take out your 800 or 900. Okay, so now you're at 4.6, but then you've got interest payments on your debt, and those interest payments are up to $1 trillion, and that's net, right? So it's about 900 billion, but let's just call it $1 trillion of net interest payments. You don't have to be a math genius to see it doesn't add up. You're already over $500 billion in deficit. So the issue here is that we run in perpetual deficit. Add in all the other programs, all the other expenses, the non-mandatory, the discretionary spending, and you come to $2 trillion of deficit spending right now, and we're not even in a recession. So we're spending $2 trillion more than we're taking in. And when I say than we're creating, that means our citizens they're productive, and our companies are productive, and the government taxes that. So those taxes don't even cover that. So what the problem is that the only way to pay for debt that now matures, since we don't make enough money and we're deficit spending, is we have to issue more debt. Now, as interest rates have risen, now those interest rates are higher. You have 50% of debt is coming due in the next 3 years. And the average yield on that debt, the average interest rate, is about 2.3%. If just think about it, every single bond that we're issuing now is being issued at 4.5% to 5%. So, or even higher if it's a longer maturity. So we're spending even more on interest, and we're issuing more debt. We're issuing now at a pace of $1 trillion every 100 days. That's every 3 months, another $1 trillion. So that's all the equivalent, all of that. These are huge numbers. So for your listeners to understand, this is like somebody who makes $100,000 a year, who's carrying $5 million of debt, and is adding another $140,000 to $150,000 of debt every 3 months. How do you will never be paid back. So you're in what's called the debt spiral. You're borrowing more. The borrowing is compounding on top of borrowing. The interest rate is getting to be too much. And at some point, it's going to overtake all of our earnings. Right now, it's about 20%. That $1 trillion that we spend on interest every single year is about 20% of that, just under $5 trillion that we make every year in revenue. That's going to, at some point, be 30%, 40%, 50%. And if we have a shock in the system, like we had in either the Great Financial Crisis or in 2020 and the global shutdown from COVID, if we have another shock to the system like that, we could see those interest payments double or more. And that's the debt spiral.
And beautiful, juicy and to the point. So actually to that point, I have a question for David. In that environment, when we look at more like the global macro picture, some have said, analysts or even like the Treasury said, even the Fed, that 5%, which is kind of like the interest rate we are at right now, the Fed fund rate, is something that the economy can actually sustain. And listening to obviously like the whole thesis about like the debt load, its interest is damaging the balance sheet of the United States. So on one side they say, we still believe that inflation might still pick up, because if we believe in a scenario like the 70s, we've just reached the first wave, and we might embrace like a pickup again in a second wave where inflation is reaccelerating. Lynn Alden, as you both know, is believing that the future is inflationary. Yeah. So where do we go from this point on?
Yeah, I mean, I think James summarized it, Alexej, that we both have distressed debt backgrounds, and as he said, if we were looking at a New York Stock Exchange company with a balance sheet like this, and importantly, it's kind of the comment I think of when you hit crisis moments, it's balance sheets then that matter, right? Like in 2008, I can remember it was like right to the balance sheet of these financial companies. Forget about the income statement. It's like, what's the assets and liabilities like? When do the liabilities mature? You're focused solely in a distressed debt market like in November of 2008 on runway. How much cash do they have to make it? And as he pointed out, with 53% of U.S. Treasuries maturing within the next 3 years, that's really tight. And I think most people in America, in my opinion, take it for granted, like, yeah, you doomsdayers, like, no big deal. The Fed has your back. You roll it. Okay, that's true. But I think what people are cavalier about is when you get this much debt in the world, it's not just the United States, it's globally. We've had a 53-year debt party. And now it's 5 a.m. and the kegs are running dry and the cops are outside throughout the world. And so what's going to happen is we're just dealing with a fragile system now. It's incredibly fragile. It probably could continue on perhaps for a while, but it's really fragile. As we saw in 2008, when you're levered, it can cut quick. And then what happens is, to your point, if the interest rates go to 5%, if you look back, I think at the data in the United States back to 1874, the average 10-year treasury traded at about 4.83%, something like that. So that's where I think they say, okay, 5% we can live with. Normally they wouldn't be wrong. Okay, but let's keep going on the debt. The debt's grown 50% in the last handful of years alone in the United States. And then what no one talks about is exponential growth and how debt grows upon debt because of what James is talking about with deficits and interest. And so something has to give. Like either we're going to have to raise taxes in the United States or cut defense spending. Okay, the world's getting a little more challenging on that front, though. It's just hard. It becomes harder now, and so therefore it's a more fragile system. And so I don't want to be long-winded, but that's how I think about it of, yes, we have a money printer in the U.S. Yes, the Fed has your back, but it's a much more fragile system, and we're in these categories of Reinhart and Rogoff analysis where debt to GDP is so high across the G7 and so many countries that there's no one there to necessarily bail out the Fed. There's no Fed to bail out the Fed the way the Fed bailed out Wall Street in 2008. That's the risk. We're dealing with a really risky system. And I think when the history books are written, God, if there's another crisis, it's going to be at the sovereign level, and it's throughout the system then. And there's no Fed to bail out the Fed. BIS could do it, but every country's got a problem. It becomes a crisis quickly.
Yeah, so and to bring that home, so let's talk through what can you do. Like David's saying, it's 5 a.m. The kegs are running dry. The cops are outside. Well, okay. So what can you do? And you're spending so much. Well, one of the issues is that you're spending deficit, $2 trillion deficit at a time that we're not even in recession. Okay, so. Can you cut back defense spending? Can you cut back on? You can't cut back on the entitlement spending. If you look at all the amount that we owe, that's unfunded liabilities, meaning Social Security, Medicare and Medicaid costs, that's another $212 trillion. Okay, $212 trillion. So when you add up everything, it comes out to be just about just under $250 trillion when you add up everything and the national deficit, national debt. So what can you do? Well, you could cut spending, you could have austerity, which is political suicide. Nobody will do that. No politician will willingly cut back their constituents' paydays. They will not cut back on programs because they won't get reelected. Look at where the incentives are. They're not going to do it. The second thing you could do is raise taxes. Well, if you raise taxes, what happens is you disincentivize productivity. You disincentivize companies to invest in R&D, invest in an expansion of profitable, lines of earnings, and so of products. And so you wind up lowering productivity, and then you have lower productivity. You have higher taxes on lower productivity. You end up getting in the same spot. It doesn't work. So what's the third thing you can do? Just issue more debt, which is what we've been doing. But when you do that, you have to allow for there to be inflation. So here's the crux. You allow for inflation, you try to control the inflation, you print money to create inflation, and then you tell the people that it's not as bad as it looks, and not as bad as it feels. You give them a CPI number that's just nonsense, when the real number is like David said, it's the expansion of the money supply. They do as much as they can get away with. Why are they doing that? We have to go to first principles on everything. So the first principles on the Fed. What is the Fed's purpose? Their aim is to have a 2% inflation rate? That answer is no. Is it to have full employment? The answer is no. Their aim is to keep confidence in the U.S. dollar. That's their aim. Whatever they tell you, whatever they say about the 2% inflation rate, the full employment, the underlying pinning, the basis of everything for the Fed is to keep confidence in the U.S. dollar. Why? Because they need people to buy U.S. dollars, use U.S. dollars to buy treasuries. They want to have people buy their treasuries. Must have people buy the treasuries. Why? Because the treasuries are keeping the whole system going. Why do you need inflation? Now go up one rung of the ladder. Okay, need to use dollars, need to have confidence in dollars, so you buy treasuries. Why do you need inflation? Because you need to keep the charade going as for long as you can. And the reason that you have inflation is to create nominal productivity growth. That means growth in unreal terms, meaning more dollars create more dollars of productivity. It's kind of fake in that it's creating higher amounts of productivity in dollar terms, but those dollars are worth less. But they can pay down that debt that they've created for fewer real dollars. That's the whole point. And that's what they're doing. And they're going to keep sustaining the system like that. Okay. Why does Lynn talk about high inflation? Luke Groman talks about high inflation. We talk about high inflation. I believe there's going to be high structural inflation forever. Now, we'll have periods that it could spike to 15, 18, 20%. Whether or not they admit to it, that's where it will go. Why? Because you'll have investors who demand higher rates of return on their investment, knowing that there's higher structural inflation, and those interest rates will have to go up. So they'll be paid for that on their long-term treasury investments. And that creates just this spiral, and it just accelerates it. And that's where we are.
It's a bit of a kind of a doom loop just overall, not just debt, but you basically are either juggling between hyperinflation basically and a total deflationary collapse, which never would happen because obviously debt would be unpayable, and thereby that's not something
they will never allow that.
Yeah,
will not happen. If you can sell bonds in your own currency, denominated in your own currency, then you will print money and buy those bonds. Look at Japan. Japan now owns over 50%. The Bank of Japan, their central bank, owns over 50% of their bonds. Mm-hmm. It's mental.
And we've seen now in the past months that actually Japan has been experiencing also quite some problems, right? They've, I think, if I'm understood it correctly, started yielding down on yield curve control.
Yield curve control, that's right.
And basically now we've seen also the yen collapsing as well, and they have a demographic problem. a lot of people use Japan as kind of like a forefront example of what could happen in most Western developed economies.
Yeah, you talk about this.
I think most Americans too will often, that are bullish, right? Which is fine, but they'll say, well, look, Japan has done it; they got away with it. It's totally different, as James laid out. It's the entitlement problem in the United States, right? The $220+ trillion, $212 trillion of debt, including an average baby boomer in the United States that's 71 now. Like, you can't pretend and extend those anymore. Those Medicare bills and Social Security bills are coming due. And so you're going to have to allocate that capital. You can't turn that off. And Japan doesn't have the social safety nets. The younger people take care of their grandparents. And Japan also is a net exporter, right? Luke Groman talks a lot about this. They've got a 64% NIP, meaning they've got foreign investments because everyone's buying Samsung and Sony products, or Sony products, I should say, use as an example. And so they own a lot of assets throughout the world. They can sell those treasuries that they own. They can sell assets to bring money home to service their economy as needed. The United States has none of that. We're negative on the NIP, right? We spend, we consume, and again, we love America, right? And I think some people associate Bitcoiners with like being anti-America. It's like, it's the opposite. What Bitcoiners are for is fairness of a system that is really broken money, where the inflation rate really is 7% plus on average. Not, is the Fed getting us to 2 this year? Like, they're fooling you. And wake up. And the inflation that you have seen, it's percolated in areas like real estate and the stock market for the last 15 years.
Asset inflation.
It's asset inflation. And now it's in grocery stores, and it's a real deal. And think about it. If you're a family starting out at 30 years old, trying to raise kids, I talk to more 30-year-olds that are scared to death. They can't afford to buy a home. How are they going to even have a family? That's sad, right? When, our government has just led you down, death traps, to debt cul-de-sacs that have now, squashed a balance sheet that can't support or sustain. And we're looking at huge tax bills otherwise if you're going to do this. And then there's an economic cost to doing that. So I don't want to ramble on, but it's a real issue. And I think people need to wake up. I think some of the ETF flows that you're seeing in the U.S. that have been driving the Bitcoin market here over the last 3-4 weeks is an example of people who've been wanting to get into the Bitcoin space. They're waking up. Like, they see that we're not crazy people. I think people are aware of this math. And I think that's really where this is going, is that more and more money will leave stocks and bonds, I believe, in particular bonds. And now there are very easy gateways and on-ramps into the Bitcoin ecosystem. And you're going to have these diversified portfolios. I mean, James in his great presentation yesterday showed those portfolio return charts of how you have a much better risk-adjusted return portfolio if you had even 5 to 12% in Bitcoin than you've done at any point on any other curve over the last, decade. Mm-hmm. And I think that more and more people are going to become aware of that, and that's how Gresham Law works. Like, in the 1970s, we saw that, right, where we went from gold and silver being less than 1% of global financial assets to then ending the decade up around 7 or 8% of global financial assets because people started buying to hedge out the inflation. What we're talking about here is it'll be something similar to that. Gold, silver, and Bitcoin today are less than 1% of financial assets. Could they go to 10%? Could they go to more than that? I mean, like Michael Saylor and Booth will argue they're going to 100%. We'll see. The point is, it's a lot higher than this, and it's now a real sound money asset, as we talked about, and more people are going to allocate 2 to 3% of their portfolio wisely to this space, and that's where it's going. And that's the store of value side of Bitcoin. Then there's the whole payments and decentralization of the network. That whole growth curve that's happening, that's the technology rail side of it. That's the two sides of the coin, I'd say, of Bitcoin as people get to understand it.
There's been a lot of talks about the soft landing is coming. We had at the beginning of the last year of 2023 was the most anticipated recession. Ended up not being actually the case in the end. What do you think is basically potentially still a risk? We've seen it just lately. I've just read an article on Bloomberg that Goldman Sachs, I think, was estimating that there was more about of 1 trillion worth of commercial real estate that's been marked off as potential loss on many banks' books. Is that something that when we look at the real estate in general it's always a precursor to other spillover into other industries and thereby recessions. Do you have any views on that?
Yeah, I mean, okay, let's pull that apart a little bit. First of all, everybody is very well aware of what's going on in commercial real estate. There's a structural problem there. People have not gone back to offices. And so your cap rate, basically the owners of those buildings are not making enough money to cover their payments on the mortgage notes. So they're walking away from them, and you're causing these huge losses at these banks, right? But that's office real estate. It is a problem. It's a big problem. And some banks are going to fail from it. And the Fed is very well aware. The Treasury is very well aware of this, and they're working it out now. I believe they're working it out behind the scenes, that they're carving up to decide who's going to get who when the bill comes due. And so what's going to happen is going to be consolidation. Some of these banks are going to go into larger banks, but it's not widespread in all of commercial real estate. Some of the commercial real estate is doing just fine. Some retail is doing just fine. Some medical is doing just fine. Professional offices, that's okay. It's primarily the office buildings that have been decimated. So that's one thing. So, but what is going to happen? Like, how is this all going to evolve? Well, and are we going to have a soft landing? Well, the question is, right now, Alexej, what is happening is that there are parts of the economy, and especially the United States, parts of the economy that feel like they're in recession. They actually are in recession. You're seeing mass layoffs across the board in a lot of tech companies. Some of that is maybe a little bit of his AI productivity uptick, and so they don't need as many people to do certain things. Maybe a little bit. But really, it's a cutback of spending to retain earnings, okay? And you're starting to see companies who have reached a limit where they can't raise prices any further. And so now they're having to lay off people to keep this, to keep their margins. Okay, so that's another thing. So, but why are we not seeing widespread, recession signals across the board? Well, because we have a monetary system that's being tightened on one hand, and then the other hand, we've got this flood of capital coming into the market from the fiscal side. We just talked about it. We have $2 trillion that's being flooded into the economy from the government. The government is hiring. It's hiding some of the employment numbers. You see the government spending, and that's inflationary. It's expansionary. Versus the monetary tightening, the Fed raising rates and selling the treasuries that they have and the mortgage-backed bonds they have on their balance sheet from 2020 and 2008, and now they're selling those. That's tightening. So it's kind of battling each other, but the fiscal side's winning. The government is spending a massive amount of money, and so that's helping all of the economy in certain areas, in infrastructure spending, in medical programs, it's a battle between the two. And right now the fiscal side is winning. So do we have a soft landing, a no landing, or a hard landing? Well, the question is, do we have some sort of credit event in one of those areas that is feeling the recession pressure? Do we have a credit event that's large enough in some sort of financial or institutional company that has the potential for what we call contagion, where it topples numerous or can topple numerous companies within that same industry or outside that industry? That's the question, because that would be a hard landing. But if we can somehow kind of skate through while we continue this expansionary spending, we may not see a recession for a while, but it will come due at some point. It's just a question of when and how hard.
Yeah, I mean, just to build on that quickly, I'd encourage people to read kind of Lynn Alden's February newsletter, her free newsletter, about this exact thing James is talking about, the tug of war between the fiscal stimulus of spending by the government versus the Fed's monetary tightening over the last year. And so far, fiscal stimulus has won out. Now, can that continue? It could. Right? It has. It is. I see personally confidence in America. If you look at the TSA data of the travelers through airports, if you look at the open table data through restaurants, the service economy is hanging in. People are spending. But I think that what happens is, as James said, it's a fragile system with this debt, as we talked about. If something goes off, the old Franklin Delano Roosevelt of the early 30s, right? The only thing we have to fear is fear itself. When you have a leveraged system, when fear kicks in like it did in 2008, now liquidity dries up. I don't want to take your counterparty risk. That's when debt systems are so fragile. That's what we're talking about is the risk. And that's a grenade that can go off at any time on any type of event. For now, it's the Fed's got your back. And yes, CRE, the commercial real estate market, is drip, drip, drip. It is a drip, drip, drip pain. There's probably 1.2 trillion it's a $3 trillion market. The office market in the U.S. is about 1.2 trillion of damage, meaning lost debt, value, meaning people paid $300 billion for an office building. That thing's selling for $100 million today. That's happening all over the place, from DC to San Francisco to New York. You'll hear about that. Those are losses. Someone's absorbing that. Some pension fund somewhere that had an investment in a real estate investment company will feel that. That will play itself out in time. But these are the things that are seeds, that are grenades, that could cause more ripple effects. That's what to worry about. For now, though, things go along. I think the stock market in the U.S. is too cavalier to the risks of that system. We're pricing in certainties when there are plenty of uncertainties out there. And I think that, what you have to watch is the job market is key. Like, I think Jeff Gundlach at Double N's talking a lot about that lately, and I think he's right. The way that the unemployment rate, if that's going to tick up higher, that's what sets then the consumption to slow down, which then causes the economy to start to buckle a little bit. That's the key thing to watch between now. Now, I think on his latest interviews on CNBC and pods that he's done a week ago or two, he'd say by June their job market could be challenging. And you are seeing Nike announcing 2% of their workforce layoffs, McKinsey on the consulting side giving certain notices to people. Now, some of these companies all overhired in the last 3 years, but either way, that's going to have an impact. So I think that's worth watching, is the job market and where that goes, and then any kind of grenades that James is talking about in this fragile system. That's going to determine whether this is a soft landing, hard, or something else.
So a lot of people get excited. Obviously, we've seen amazing prices across the board. Stocks has been mainly, and I'm talking under your control, the Magnificent Seven, outperforming the rest of their peers. But then we've seen Bitcoin that's made an outrageous move in the last months. We had the ETF that obviously was a catalyzer. So now the question is, are we on trend, or was the ETF just a blip like COVID was before that on the opposite side? How do you see in general the price action compared to more of because we just talked now we on the midterm we have a looming recession. On the other hand, we have people getting super excited, saying the bull run is back, let's go to the moon. So how do we
reconcile that? How do you reconcile that? Yeah, so it's a good question. First of all, the only prediction I'll make in Bitcoin price is that it is going higher in the long run. I expect it to be volatile. It's fully expected to be volatile. Now, what happened the last 6 or 8 weeks? Well, what's gone on is that the approval for the ETFs is a catalyst. It's massive. Why? Because prior to the ETF, you have this whole family of institutions that do not have access to Bitcoin. They literally cannot buy it. Why? Because they don't have the function operationally to trade it on an exchange that is approved within their institutional charters. They don't have a prime broker to hold it and custody a custodian with, to borrow against like a normal asset in their family of assets. They don't have a function of, once, who's gonna hold the keys? Who wants to hold the keys of are they going to do a multi-sig? Are you literally going to have a set of investors from a major institution that have keys that they're all managing. Like there's too much career risk, there's too much personal risk, and too much fiduciary risk. They can't do it. So they literally could not do it. RIAs, registered investment advisors, they weren't allowed to sell it to their investors, to show it to their investors, to put it in their portfolios. Why? Again, the same reasons. But now with the Bitcoin ETFs, the spot ETFs that actually own Bitcoin, well, they can buy it with the same brokers on the same exchanges, settle it and borrow against it with their same prime broker, custody it with their same custodian, and they'll settle it in the same exact way, just like a stock. There's absolutely no difference to them now, and it's super easy for them to do that. So that super highway was built for them to start owning these things and to have it as a separate asset class. And so what you're seeing now is those on-ramps to the highways are being built. And that is the registered investment advisors who are being approved to either buy it for their portfolios or to present it to their investors. You're seeing it in the institutional side where the large institutions like Texas Teachers or CalPERS, pension funds, retirement funds who can actually own this just like they would with any other stock. And they're starting to dip their toe in and they're starting to accumulate. But it's just the beginning. Is this a blip? No. This is an indication. Could it go down from here? Yes. Would we be buying more? Yes. But that's the way it works, yes. That's exactly the way it works. But in long term, the Bitcoin, I have absolutely no doubt in my mind, is going to be worth $1 million a coin. But at the time that's worth $1 million a coin, who knows what that $1 million is worth? We'll see.
I came across like this really wild theory, and I'm just gonna check it with you because I think it's a bit too wild. But bear with me. Mm-hmm. So it's been from this account on Twitter called Stack Hodler. I'm not sure if you're familiar with him. He's been, I think, putting out some gems every now and then.
He's fantastic. He's out of Switzerland.
Switzerland, yeah. Exactly. Yeah.
He's sorry. I didn't have my mic up. He's fantastic. He's out of Switzerland. He's awesome. Yeah.
Yeah, and he just shared. You might have seen this one. It starts with: Is the United States playing Bitcoin chess while the rest of the world plays checkers? And he basically lays out kind of like a scenario that he thinks that's through the Bitcoin ETF would play out. So now take into consideration everything we said. Flood the world with dollars, that's step number one. Ignite global inflation. Number two, jack interest rates to the moon. Debt-laden Europe, China, etc. Caught flat-footed, provoke wars to strike further. Step three, in the meantime, blow up the crypto Ponzi's to scare everyone. But then four, pull a sudden 180, get everybody onto Bitcoin. Every boomer, corporation, pension fund, etc., 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 your cat, your dog, all of it. But in a way of, and now I'm just cutting short because it's a long thread. I'm gonna put it up into the in the description. But basically, the idea of having on-ramp as a First Nation move, being the United States, seeing okay. If we do want to have an edge above anyone else and we can't control the inflation game, well, let's just inflate it to the moon through Bitcoin, get everything we can on Bitcoin, and be the dominant nation that basically controls that stack on the world level. It's very far-fetched, I know, and I'm not sure if it's clear the way I laid it out.
No, it's clear, very clear. But,
Johnson thing.
I think that. Look, anything's possible, and I love when people throw ideas out there. I think it takes courage for someone to take some big idea and throw it on a table. That's where, anything's possible, and it's always great to think about these things. So it's possible. I think that the challenge you have is a couple of fold. One, the Brent Johnson theory of Santiago Capital of the dollar milkshake, right? That because post 71, really 73, 74, Henry Kissinger cuts a deal with the Saudi Arabians. I'm oversimplifying, saying we, the U.S., will protect you, Saudi Arabia, with weapons and defense if you price every commodity, oil, in dollars. And so effectively, that's how the vast majority of all commodities, largely oil, and then all other commodities were priced in dollars then from 73, 74 onward, right? So that created the dollars, the U.S. reserve, the world global reserve currency. That's obviously gave the U.S. a huge leg up, because then we were the reserve currency. We could print dollars. We could allow our consumers to buy as much goods made in China and ever. And that's why America has seen its wealth grow, right? But is it true wealth given the debt we're talking about, right? And I think that where I'm going with this is I think that it's tough to get that dollar to really break. That takes time. But secondly, on that theory, like, while possible, I think that personally most politicians, 85 to 95% of them, are kind of well-meaning people who likely get caught up in a system that are bought out by special interests, lobbyists who then influence their decision-making. To think about a lobby that was probably blocking to allow the Bitcoin ETFs a year and a half ago, to then suddenly eventually they have to cave. And I think that if that theory were right, given the debt load that we talked about, 53% of all U.S. debt maturing in the next 3 years, they don't want interest rates to go up. That would cause chaos. That would cause riots in the inner cities. Only about 10% of people in the United States really have assets in the stock market. Like, this is what we're talking about, why Bitcoin is about fairness, and it's about getting back to first principles of digital money and how money should be, to allow that quote-unquote American dream to exist for anyone, where if it's a proof of work, if you work hard, you can go earn a living and rise up, earn a salary to buy a home, to raise your children in, to live the life you imagined. Right? And I think that somewhere in the United States, in my opinion, died. And I think that's a tragedy. And that's why this was once a great country. I'm talking about my home country, U.S., and it will be again someday. But it's a mess right now, and a lot of dreams have been sold down the river. And so I think the point I'm making, I'm being long-winded, but I think it's awfully hard to imagine a world where the government really is thinking chess like that. In my opinion, they're thinking about the next election cycle.
It's a giant smokescreen.
Yeah. I think it's more just they live 2-year cycles in the United States in governments and maybe 4-year cycles, and it's all short, and that's the problem. It's never well thought out. There's never a thoughtful plan around budgets and deficits. It's all just get to the next election cycle.
What's the plan? There is no plan. Just get reelected.
Plan B.
That's right.
Do you have anything to add? We're coming to an end because obviously we still want to see Jack Dorsey.
Yeah, we need to see Jack. No, I mean, this has been great. Thank you. I appreciate it, Alexej. And just the thought of, just like David said yesterday, Michael Saylor's speech. If you haven't seen it, go. If you have access to it, go online and watch it, because it was really fantastic and laying out everything that we just talked about a little bit more elegantly and intelligently. No surprise. And but we have hope. We're not against anybody or against anything. And all these things I talk about with the debt spiral, with incompetence or the spending, just irresponsibility. That's all just to make people aware that Bitcoin is important. It is your tool for survival. It's not against anything, but it will help you store that value that you've worked so hard to get. And so it's the ultimate store of energy. You've expended this energy. You should be able to store that to spend it later. And so that's the point. And that's why we're here, is to spread that word and to get more people on board so the ecosystem grows, that the Bitcoin ecosystem gets stronger, and that more money comes into it, not for number go up, but for just further stability and for everybody to be using it in a way that allows them to store that energy and carry it with them anywhere in the world with them.
And to build on James's point and just Saylor's just very quickly, yesterday Saylor's presentation, which I echo James' thought, I mean, everyone should watch it. Bitcoin is not here to attack the government. It's more that, as Michael said, that it's just that the government hasn't seen yet the benefits of Bitcoin like we all have. They will see it in time, right? Whether a crisis, usually, unfortunately, a crisis usually happens and then they see it. but like they will understand what we're talking about and how the last 50 plus years have been, a lot of mistake, a lot of how did the U.S. get here with this deficit? Well, $6 trillion wasted money in wars in the early 2000s, and then more over time, and it's just a lot of government waste that doesn't lead to productivity, that doesn't lead to growth. And ultimately, though, you need to fix this money supply because of the debt problem. And so I think, as Michael said, like, we're not here to attack anyone, Bitcoin. It's more we're trying to spread the word of what a better economic system can look like on the other side, what a better form of money can look like. And ultimately, I think that they will see it too.
Right on.
Actually, if you think about the theme of, the name of Bitcoin Atlantis, Atlantis has been kind of like a mythological story that Pluto was writing about, this utopian city that was governed by semi-gods and semi-humans until they basically got caught into obnoxious deviation of morals, corruption, and all that we've been witnessing today. And Bitcoin and sound money in general, so you could also maybe count gold and silver as that, is restoring and maybe actually getting Atlantis from the depth of the ocean back into the scratch of the earth.
It's a great analogy.
Love it.
So on that note, actually, because we talked a bit about gold and silver, but I'm wondering in this whole thesis, I see a lot of sometimes even hostility towards gold and silver, but I don't really understand it because it's been kind of like the precursor and the physical form of it. But where do you see gold and silver in that new world if, let's say, we go towards that hyper-Bitcoinization and so on?
Obviously, there's news stories out today on the BRICS still continuing to talk about it, right? The global south, the BRICS. They are, you see the Shanghai Gold Exchange set up a few years ago. You see Saudi Arabia selling oil to China, last year for yuan. And JP Morgan had this stat out a couple weeks ago, right? That over 20% of all commodity sales globally were outside the US dollar last year. That's a big difference versus 100% before. It's happening. And what the BRICS are talking about is how do they create their own form of currency think an alliance like a NATO or a NAFTA in North America, where it's a trade agreements between countries where there's settlement in currencies. And ultimately, gold is probably what they understand on most of those countries in the world. And that's really what's being talked about. It's a basket of other commodities, but gold being preeminent in that. I think it's been amazing why gold bullion prices have actually hung in there over the last few years, despite global M2 money supply declining. It's probably one of the more bullish things you could see.
5% interest rates.
And 5% interest rates. And yet there's a huge gap between gold miners and gold bullion because of the inflation in the miners. Those companies take a lot of funding. The CapEx spending in the gold miner space has been anemic for now about 12 years. All these things remind me of opportunity. It reminds me of investing in distressed oil and gas debt back in 2017, 18, 19. People would tell you, oh, ESG has killed the oil and gas. It's done. No one will ever own it again. Well, they forgot. Well, we still need the stuff. And there was CapEx starvation since 2014. So eventually you're going to have a tight market. And I think gold is kind of approaching those type of things. Silver certainly is, because of the demand for solar and electric vehicle needs for silver in those solar and electric battery industries. And so while that will be volatile with recessions that might cause temporary declines in purchases of electric vehicle, the next 7 years, Ronnie Stoverly has a great chart on this, that of all the commodities in the world, when you look at 2030, the supply-demand gap, there's nothing bigger, no commodity bigger supply-demand gap than silver in the world, right? Because of the solar and electric vehicle demand. It's probably the most misunderstood asset out there. So while I think Bitcoin is the fastest horse in the race as a digital commodity, digital money, gold and silver are very well positioned because of how everyone's ignoring it, how low the sentiment is, how Bitcoin people will laugh and say it's dead. I don't think it's a mutually exclusive world. Gold demonetized silver, Bitcoin will demonetize gold and silver, but gold and silver both performed very well over those times, even though gold demonetized it. The world is full of multiple assets, and there are people looking for value all the time. I, for one, think that gold is a cousin to Bitcoin, and it's going to get pulled along with it. I think you started seeing that a little on Friday afternoon yesterday as well. So I'll pause there. I've been long-winded, but incredibly bullish Bitcoin. It will be the single greatest asset in the world, in my opinion, over the next handful of years. But gold and silver are probably two of the most undervalued assets right now in the world.
On that note, thanks a lot. We've reached the golden hour.
Yeah, thank you. Well said. And thank you for having us, Alexej. Well, let's go see what Jack has to say.
Yeah, thanks, Alexej.
Exactly. Thanks a lot. Appreciate it. Thanks for watching. If you liked this episode, give it a like. And don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.